Hi everybody, this is Ted Bauman here, editor of the Bauman Letter and of Bauman Daily. Before I start today's video, I just want to point out that my colleague Clint Lee has developed and has just launched a new options-based trading service called Flashpoint Fortunes. It's based on an analysis of behavioral or behaviors of traders in the quant market, money that they are gearing up to spend on certain stocks. He tries to identify where these pushes into the quant market are going to come, or from the quant market. And he's had an excellent track record. He has had a couple of triple-digit gains already. We've only been doing it for a couple of months in our beta testing, and it is outstanding. So please look at the link below if you want to subscribe to this. I strongly suggest that you do. Now, on to this week. This is my first YouTube and Bauman Daily video for the year, so welcome, especially to those of you who are YouTube followers. I appreciate you being here. Well, big news of the week. I'm going to start with something unusual and maybe predictable. Elon Musk, look at that handsome face. He is now the richest man in the world, at least for now, until if and when the Tesla share price begins to change. He's done a very good job for himself for a wiki from Johannesburg, and I congratulate him on making such a good run of it. Whether we can keep all that money or all that wealth, Elon, we'll see. Second big issue this week, it's been an interesting one. Yesterday, I'm recording this on Thursday, we saw the interesting videos and pictures of what was happening at the U.S. Capitol. Now, back in the old days, in Germany, they used to call this a putsch, P-U-T-S-C-H was the German word, and it basically meant a group of people attempting a rapid, small-scale insurrection against a government, which is kind of what we saw yesterday. So I wouldn't call it a coup, but Gregory Dacre, chief U.S. economist for Oxford Economics, did call it a coup. And the question he asked was, how much was it worth to the stock market? Well, I pulled up this chart, which shows that it was worth roughly around between -6 and -7%. So there you go. The other headline that came up yesterday that was amazing, that I still think is one for the ages, as I put it, was right here. Markets up, the Dow strikes record levels as protesters occupy the Capitol. That's a headline you don't expect to see very often, folks. Anyway, let's leave the politics aside and let's look at what's happening in the economy and what that's going to mean for 2021. First of all, I think this chart shows an important story that a lot of people weren't expecting to see this late in the COVID pandemic, and that is a negative figure for ADP payroll changes this month. It's not a huge one, but it is enough to cause some serious concern. People are losing jobs again. We saw big job gains just after the big dips in March and April, but they have moderated, and since October, really, as you see from the chart, they have been falling. The numbers created new jobs, and now we are in negative territory. So what's happening here? Well, first of all, I think the Fed has reduced the cost of borrowing for companies, so companies feel comfortable borrowing money on the market and then using that money to try to replace labor fundamentally. When companies are trying to scramble for a bigger piece of a smaller pie, when markets are shrinking because people don't have as much money in their pockets to spend, as has been the case this year, either because they've lost income or because they've chosen to save some income for a rainy day, the fact is that companies have to figure out ways to keep their earnings up, keep Wall Street happy. And they do that by cutting jobs and replacing those functions to the extent that they can with technology. That has some bullish effects for some stocks, which I'll talk about in a moment. But across the board, that means that we will continue to see significant pressure on the labor market, I think. And a lot of it depends on what's going to happen on the stimulus front coming forward. But fundamentally, I think this happens every time there's a big pullback in the economy. You see big companies trying to figure out how to shed labor, maintain efficiency, maintain profit share and market share. They can't raise prices because people are cutting back on spending, but they can cut jobs, and to a certain extent, they can cut wages. And that, of course, in the long term feeds back into the same problem that has caused them to have to do that in the first place. And that has to be made up somewhere, and that somewhere typically means government stimulus to restart the cycle of the economy. Now, in our situation, of course, everything depends on what happens with COVID and with the situation in just the general economy, and nobody knows what that's going to do. There's a new variant of COVID out. It has taken over in my home country of South Africa, and they're now back onto lockdown that was just as severe as the one that happened just after the first outbreaks in March and April, and my friends down there are not happy about it. But what can you do? This is much more contagious, more dangerous. We know that the vaccine rollout in the United States is going very slowly. So for all intents and purposes, we are facing a situation just as dire as the one that we faced back in late spring, even though a lot of people don't seem to have recognized it yet. Nevertheless, that is going to continue to put pressure on labor markets. It's going to continue to put pressure on corporate profits, and they're going to keep trying to solve that problem by trying to substitute technology and capital for labor to increase unit productivity. And that, again, will put pressure on the labor market and rinse, repeat. So a lot depends on what the government is able to do by stepping in to make up for some of that spending that is not happening. Now, on that score, what about the election? What is, now that we know the outcome, now that we know that here in Georgia, both Democratic challengers squeaked through just by a hair's breadth, or a coat of varnish, as we say in cricket. Well, the first thing is that now that we know that the Democrats control Washington, or will after the 20th, I think investors have taken this as a verification that that big stimulus, the $908 billion approved in December, is just a down payment. There's going to be more coming one way or another. Even if the Democrats have to use reconciliation, more money will be pumped into the economy. There will obviously be arguments about how it should go and what kind of spending it should be. But it's not just the stimulus, I think. We're also looking at the potential for very significant investments and other kinds of stimulus, particularly for certain sectors. Now, who are the big winners going to be from this? Well, one could be the consumer economy. We could see a repeat of the big spending on consumer items that we saw early in the pandemic, which really showed up mainly in a trade deficit with China, paradoxically. We bought a lot of stuff. About $60 billion worth of consumer goods were bought in excess of a normal year in 2020, and that was almost exactly the same as our trade deficit with China. So think about that for a second when you think about stimulus. The other issue, of course, is what's going to happen with the pet projects and sectors that the Democrats are understood to like. Well, I looked at ETFs this morning, and I tend to look at a range of them and see who's winning, who's losing on the news. Today, the big winners are renewables. The renewable, I would say probably 7 out of the top 10 ETFs today are all in the renewable energy sector, particularly solar, wind, and electric vehicles. That is going to be a big winning sector. And if you haven't started investing in renewable energy stocks or ETFs, now is the time. Don't wait. I've done so. We've done so in my profit switch. And that is going to be a big factor going forward this year. So renewables is where you want to be. EVs, electric vehicles, have also done well, including some Chinese stocks, which were beaten down a bit towards the end of December, but have bounced back strongly, including companies like NIO, Li, XPEV, or XPeng rather. And all these companies, I think, are just basically being pushed along by or being sucked along, I guess, by the headwinds, tailwinds, vacuum, whatever you want to call it, of companies like Tesla and the emerging breed of particularly commercial vehicle companies that are coming up. There are a lot of companies in the US and Europe that are trying to attack the commercial vehicle market. Forget about Nikola, that's yesterday's news. There are others. There's Workhorse. There is, there are companies like well, anyway, there's a lot of them. Basically, they're out there and they're trying to crack this market. Tesla's trying to do it with the Tesla Semi. Personally, I don't think it's the right technology for long-haul heavy freight, but it's the one to watch. So sure, the short-term play, buy Chinese EV stocks. Long-term, look towards US and European manufacturers of light, medium, and heavy-duty, especially heavy-duty trucking, which I think is going to be good for the hydrogen power sector, which, by the way, we've seen some big jumps this morning. Plug Power, Bloom Energy, both hydrogen power companies, big jumps today on news of deals with South Korean companies, joint ventures, but also just more generally as part of that longer big deal. The other thing I think that's going to be happening is we'll see business software doing well, particularly software that helps to cut labor costs and substitute technology. As I mentioned earlier, that's going to be a trend coming from the results of any kind of recession. As I said, companies try to shed labor, they try to become more effective and efficient. And one way they can do that is by investing in business software, which is primarily cloud-based, so software as a service. That's a big sector. Did well in 2019, pulled back a bit in 2019, then rebounded and pulled back again this year, partly because companies were not spending on investment. Now they're going to start doing that in order to, as I said, to cope with trying to chase a bigger slice of a smaller pie and saving money, and that means software. So that's another sector I'm bullish on, business SaaS companies. Housing may do well. Housing, it depends. The big issue here is whether or not people's incomes go up by more than the cost of the price of housing is rising. We've seen pretty strong rises in housing prices across the country. I think it was 6% in December, big monthly rise. We're also seeing pressure on interest rates. Bond prices have been going up for the last couple of days, or at least the benchmark 10 years yield has been going up. And that's putting up pressure on mortgage rates, which means that the cost of buying a house is rising. So a lot depends on whether or not that is balanced by more money in people's pockets, which again will depend on stimulus. So while I was very bullish on housing and we made a lot of money in the market last year, this year I am waiting and seeing what's going to be happening in that all-important market. My gut feeling is it will probably bounce back, but a lot of it depends on progress on the vaccine and COVID front. Now, what about losers? Well, one that is already showing some weakness this morning is the utility sector, XLU. The ETF is down pretty strongly today. It's understandable because the understanding or the assumption is that the Biden administration will put pressure on the remaining fossil fuel powered utilities around the country to change their investment strategies and their energy generating strategies toward renewable energy. I was driving through Oklahoma in December and saw these big new wind farms there that are enormous, and they work. They generate electricity. Plenty of wind out there on the plains, and anybody who is still looking at gas and fired power plants will know that it's not the way of the future, and the assumption is that the Biden administration will try to speed that future up. So utilities, I think, is going to be a loser this year, at least some of them. Big renewable energy utilities like NextEra Energy and others may do well, but let's see. Consumer staples, I think, will continue to face some weakness. We're seeing weakness in today's trading. And partly that's because people are squirreling money away and they're going to need to save some just in case, since nobody knows what's going to be happening. So that'll be a short-term weakness. We're seeing pressure on those stocks today. Their ETFs are also down. The other one that is likely to suffer long-term damage extending into this year is commercial real estate. Some people try to make the case that big companies like Simon Property Group will bounce back from the collapse in mall valuations and mall tenancies and rents and that sort of thing. I don't think so. I think it's still premature. But remember, it's not just retail. It's not just malls either. It's all kinds of retail, including smaller stores in urban centers like in Manhattan, right across the board, vacancies because people are simply not there. They're not there because they're not working downtown as much as they were, which means there's also pressure on commercial real estate in the office space sector. So right across the board, I think commercial real estate and commercial real estate REITs are going to be one area to watch out for. Other kinds of REITs are going to do very well. I think there are some retail REITs, particularly those that operate in the open mall and grocery store sectors, that are going to continue to bounce back. Others, not so much. So I'd be very cautious about commercial real estate this year. Agriculture, I think, is going to take some strain in the short term. Big companies in the ag sector, especially the big dominant ones, corporate ones, because there's a perception that the Democrats will probably cut back some of the subsidies that have gone to U.S. agriculture over the last 4 years. It's a little known fact, but although, people often say that the Democrats buy votes with welfare payments to voters, the Republicans do the same thing with payments to farmers, energy subsidies, and so on. It's a game every political party plays. The perception is, though, that the Democrats won't be as friendly to big agricultural subsidies as the Trump administration was. And so right now we're seeing a downturn in some of the big agriculture stocks. I think that's going to continue into weakness all year. Maybe not so much commodities. We might see an increase in demand for agricultural commodities if the virus abates around the world. But for now, I think it's a stay away sector. What about China, finally? China has been a sector that has been frustrating all year. The reasons, of course, for that are easy to understand, and that's because the stocks deserve high valuations, companies like Alibaba and Tencent, but they've been under pressure from their own government and from the US government. In China, the government has tried to rein in the power of a lot of the big tech companies, particularly putting pressure on Jack Ma, ex-CEO of Alibaba and current CEO of the Ant Financial Group. But also in the US, the Trump administration has issued a flurry of restrictions on potentially delisting some of these companies. Wall Street Journal reported that Baba and Tencent might actually be delisted. Of course, Tencent is an over-the-counter stock, but the basic message here is that they're getting pressure from both sides, and that is pushing their share prices down. So a lot of it depends on what happens with the Biden administration. Do they relieve some of the pressure? Do we go back to some kind of a modus vivendi with the Chinese that allows those stocks to continue to trade? No telling. So we have to wait till January 20th. I don't think there'll be any delistings before then. So if you hold Chinese stocks, don't sell them. But be ready to do so if and when there is bad news on the horizon. One company I will mention is one that we've held before in the Baumann, that's Bilibili. We sold them for a pretty solid gain. They have continued to rise, actually, somewhat after we bought them, and right now they're on a momentum-based tear. So there's a tip. If you're interested in a Chinese company making a lot of money, they are a video platform. They tend to do things like animes and games and that sort of thing, but they're extremely popular and they are moving fast. So there's a free tip. Finally, deficits. What's going to happen? I think a lot of people will be worried about deficits. They will worry about the Republicans will suddenly become concerned again about deficits after 4 years of not really caring about them. It's a natural, normal. It's just like the sun rising and falling in Washington, D.C. The bottom line is that I wouldn't worry about federal government deficits right now. Private saving has taken up a lot of the slack in the balance of accounts. I am an economist who tends to use the sectoral balances approach to understanding how the economy works and how money supplies work. I think right now we're not in deficit danger. Obviously, there will be a lot of discussion about it, as I said, partly politically driven, but also we're starting to see interest rates rise, and the IMF and other big players are starting to raise noises about debt burdens around the world, and it's a true thing. They do have to be dealt with. The way to deal with them is to get the economy growing quickly so that tax money comes in, and that does not mean austerity. That means helping the economy to grow. I am a fan of government stimulus. I make no bones about it. I know a lot of people disagree, but under the current circumstances, it is what is necessary, particularly given the fact that, as I've just explained, a lot of big companies are cutting back on their spending. This is it from me this week, Ted Baumann, signing off.